Hello and welcome to this IBSA podcast on the topic of US exposed persons moving to Europe. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. And today I'm joined by Darren Hayden-Joseph, specializing in international cross-border taxation for US individuals. Maybe they're moving to the UK or beneficial regimes such as Spain or Italy, or other fairly high tax jurisdictions such as France and Germany. Darren will also be covering the taxation of trusts in the US and beyond. So there you are. Darren, what are your key points that you'd like to talk about?
Hi, Roy. Pleasure to be here again. My name is Darren Joseph. HEJ.tax, a member of Moore's Rule, and we're a team that seeks to demystify the sometimes confusing role of international tax.
On the basis that you transferred to a trust, for example, before you arrived, so you sell to a trust, can you just briefly explain, and probably you won't be able to do it that briefly, the grantor and the non-grantor areas, so that when somebody is a US resident, how are they taxed on the income of the trust?
That's another common question. Once we get on to calls for US immigration tax planning, the first thing that people want to talk about is a trust. And naturally so, because the media plays with it a lot, plays with the concept and creates the idea that it's this panacea, there's this silver bullet that will solve all their problems. Unfortunately, it does not. So under the US tax code, you have grantor trust and non-grantor trust, which roughly equate with revocable trust under England and Wales and irrevocable trust. So that's roughly what it is. By virtue, regardless of whether it's a grantor or non-grantor trust, having a foreign trust, it's a good idea. So we never discourage people because of two things: asset protection and succession planning. As we all know, the US is very litigious, and I always tell people, if you do business in the US and you haven't been sued, it just means you haven't been in business long enough. Everybody gets sued at one point in time, which is par for the course. And it is super helpful to shield your assets and have it in that foreign trust. There's also succession planning. You legally avoid probate, and more importantly, if you trigger the estate tax, then those assets already in that foreign trust would be shielded from that calculation. So that's helpful. Now, but from a tax point of view, in terms of an income tax, if it is that your trust is categorized as a grantor trust, which most of them would be, then unfortunately a grantor trust or foreign grantor trust for US tax purposes is transparent. So all the distributions within, or the income producing activity within the trust, flows directly onto your personal tax return. If it is that you have a non-grantor trust, then yes, you will only, at the very least, you'll only be taxed on that portion of the distribution that will go to a US exposed beneficiary. But if it is that if you've settled the trust, and therefore you're the grantor of the trust, and you move to the US, within 5 years, it's automatically a foreign grantor trust. So even if it's set up to be an irrevocable trust, no, there's going to be a foreign grantor trust, unfortunately. So there's no tax benefit. There also, because of this very nature, people want to engage in tax planning. The IRS has a series of code sections from, I think, section 671 to 677, excluding 672, I think, that deem trust to be grantor trust for just the slightest amount of control or that a US exposed person would be. So in fact, what you have is a situation, you need to plan outside of 5 years, and chances are you probably would have needed to get US counsel involved to ensure that it was drafted in contemplation that the trust will become US exposed, which many people don't. So that's why most don't qualify. So the foreign grantor trust, in summary, is the holy grail, but it is difficult in the pre-immigration tax planning process to achieve.
Okay, so controlling in any way of that trust can cause a big problem.